So we're now ready for the conclusion of our Chapter 9 video lectures. We're looking at different type of ratio analysis that focus on liquidity, solvency, and now we're focused on how profitable is a business organization. Next up is our return on equity ratio. Return on equity ratio, which focuses on the use of investments to earn net income. So we're now saying, how does the issue of shares of stock translate into net income being earned for the business? So you take your net income divided by the average total stockholders' equity. Again, your net income divided by the average total stockholders' equity. Whenever it says average for any ratio, you'll take that beginning balance plus ending and divide it by 2 to get your average. So again, for year 4, net income was 25,000, average equity was 330,000, return on equity was 7.4% compared to 7.6% in year 3. So as we see, we are slightly less profitable in terms of using equity to generate net income in year 4 compared to year 3. Okay? The next few ratios focus on stock market ratios. Stock market ratios. These ratios focus on dividends and the increase in stock value. So if you're considering investing in a company, these are the type of ratios you should take a look at before you decide to buy stock in any business organization. First up, the most common is called earnings per share. Earnings per share. Earnings per share shows the net earnings available for common stockholders divided by the average number of outstanding shares of common stock. Okay? So let's take a look at our year 4 earnings per share. To get your net earnings for common stockholders, it is your net income minus preferred dividends. Again, net income minus preferred dividends. Meaning that preferred dividends are dividends paid out to what's called preferred stockholders, which takes away the earnings available for the common stockholders. EPS is a calculation only for the common stockholders. So it's 25,000 in net income, but 3,000 was paid to preferred dividends. So there's 22,000 available for common stockholders. To get the average shares of common stock outstanding, once again, is beginning shares outstanding plus ending and divide that by 2 to get the average. So the earnings per share is $1.60 per share. Now, what does this value mean to you? Well, remember, when you are a shareholder of a corporation, you are part owner. This is showing on paper your portion of the profit that was earned by the actual business. So for every $1, or I'll say for every 1 share you own this company, your earnings was $1.60 per share. Now, this is not saying they're going to pay you $1.60 for every share you own that company, but on paper, because you are part owner of the company, this is showing your portion of the profit that you earn by being a shareholder of this company. So the higher the earnings per share, it means that company is more profitable and they probably will be a good company to invest in. Okay. Next is book value per share, which measures a share of a stock in stockholders' equity minus preferred stock divided by the outstanding common shares. Again, stockholders' equity minus preferred stock divided by the outstanding common shares. So this ratio is not as used as often as EPS, but it's still a good ratio. So pretty much this is showing you what should be the value of each share of your stock that you own in that company. Again, what should be the value of each share of stock you own in that company on paper? So you take your stockholders' equity minus any preferred stock a company issue divided by the outstanding common shares. So again, not the average. So outstanding now will be what's outstanding at the end of the year, and that's $20.80 per share. So we're saying on paper, each share of stock you own is worth $20.80. Now, of course, you can compare that against the stock's actual fair market value by looking at the actual stock price at this point in time. But this is saying, based upon on paper, each share of stock should be worth $20.80. And again, that's just for the common, not for the preferred stockholder. Next up, we have what's called the price earnings ratio. The price earnings ratio, which focus on the earnings per share of a company to the market price per share of the company's stock. So remember that the market price per share is that if you look up Google, Apple, Tesla, Amazon right now, it will show you the current market price per share. So we're now comparing that market price per share against the earnings per share. Okay? So for example, let's assume that we got three different companies, and this is showing their market price at that point in time compared to their earnings per share. To get the price earnings ratio, you'll take the market price per share. So for Avalanche, for example, the market price per share was $43.20. Okay. And their earnings per share was $3.60. So if you take 43.20 and divide that by 3.6, that'll give us a price earning ratio of 12. So what does that mean? It's saying that the current market price is 12 times higher than the earnings per share. And once again, if you're comparing companies to try to determine which company is a better investment, the higher the price earning ratio, the better. So if I'm making a decision on who to invest in based on this data alone, I'm going to choose the Cyclone company because they have a higher PE ratio. So you're taking the market price per share divided by the earnings per share to get your price earning ratio, which is saying that in this case again, the current market price for Cyclone is 12.5 times their earnings per share. Okay? Next up, we have what's called the dividend yield ratio. Now, keep in mind that not every company offers dividends. All right? But with the dividend yield ratio, you're comparing the dividends per share a company is paying against their market price per share. So if a company doesn't offer dividends, you cannot do this calculation. But now we have two different companies, Dragonfly and the Elk Company, and they both offer dividends. And here the dividend price per share is $1.80 for Dragonfly. Market price per share is $40. The dividend yield is 4.5%. Compared to the Elk Company, dividend per share is $3. Market price is $75. Dividend yield is 4%. So this ratio is again comparing dividends per share. That's the amount. So dividends is the actual amount being received by the stockholder. So when you own share of stock or company, if they pay out dividends, you'll receive those as an actual payment compared to the market price. So once again, you want a company that offers a higher dividend yield. So I would choose the Dragonfly because I could buy a stock for $40 and get dividend for $1.80 compared to the Elk. Yes, I can buy a stock here for $75. That's a higher price and get a dividend for $3. So I see that with the Dragonfly company, they have a higher dividend yield when I compare the dividend per share against the market price per share. Okay, this is just showing a summary of all of those key ratios that we've covered here in chapter 9. These focus on liquidity, how quickly can you take care of your current obligations. These focus on solvency, the ability to take care of your long-term obligations as those obligations become due. These focus on probability, how profitable is a business organization. And these last ratios are based upon ratios dealing with the actual stock market. Okay? Now, these ratios are good. However, there are limitations. So we're saying that these ratios are used as a general guide. So when you're trying to buy stock, I'm not saying to just use these ratios, but they could be part of your process. You should also do things and study those companies, look at their products, any type of pending lawsuits. But these ratios are a general analysis. There are other factors that will impact whether or not, whether social impacts, accounting procedures, industry attributes. There are other factors that are going to that should impact your decision making process, but these ratios should be a good starting point when you're trying to make a decision about a company, whether to loan them money, whether to invest in those companies, whether to work for that company, or even become a customer. These type of ratios will help you in your decision making process. Okay. Now, very true. Financial statements is only as reliable as the data on which it is based. So we're saying here is that the information on those financial statements need to be accurate in order for that to be reliable information. Okay? So that was a lot, but a lot of good information. So I hope you have enjoyed our chapter 9 video lecture. Until next time, bye bye.